Hello and welcome to Bunnex Investment Group. This is the second lecture in our updated free version course. We talked about the market manipulations in part 1, and for you to fully understand the whole course, you need to watch it to have the right foundation. But before we jump into the whole video, be sure to check out our free Telegram channel using the link in the description box below. So on that note, please, if you want to engage with all our services, only use the links provided in the description box below. There are several people coming in comment section with links to Telegram channels, websites, or even WhatsApp numbers. They are all scammers. So in this video, we are going to define what levels are. We'll also talk on how levels are created and the psychological number in trading using the levels. Then the guide to counting levels, and if you really want to understand this concept of levels, you need to watch till the end where we'll give the real market example. So for those who would love to get our services, we have a discount running throughout November. That is for $85 you get a recorded full masterclass, which was actually recorded in our real October masterclass. Then a peak identification template, which simplifies how you locate peaks as well as seeing reversal points. Then 1 year access to our Telegram VIP signals channel, where we share entries, stop loss, and targets. So to get this, use the Telegram link in the description box below only to contact us. The first topic is levels definition, and levels are defined as market impulsive rises or drops, and they indicate market makers' involvement in the market flow. As we said in lecture 1, market makers are guys or companies or even banks, some brokers who have access to large amounts of capital, which allows them to move the market at will by actually altering the supply and demands of currencies. So these impulsive rises or drops are separated from each other by consolidation or price pullbacks. So after an impulsive rise, we may see a price pullback, then another impulsive rise being issued. So the concept of levels was first used as Elliott wave theory. And knowing how to use levels is actually a major advantage of getting better trades. You'd see that someone who knows how to count levels will have more odds of winning in the long term than someone who doesn't. So here's just a basic structure of how levels interlink with each other. Whenever we see an impulsive rise, we'll call that making a level 1, and that level 1 can be terminated by an impulsive by a pullback. Then after that pullback, market makers will get involved again to issue another impulsive rise. Then this will actually be terminated either by a consolidation. So it doesn't necessarily mean that consolidation will come in level 2. It may come at this point, and then after 3 levels we reach the ultimate reversal point, which is basically the level 3 peak. So another question is, how are levels created, or how do they actually come up on the markets? In trading currencies, there are external authorities. For instance, the International Monetary Fund, which is basically the IMF in abbreviation. This governs how currencies are traded and put in place policies to stop either over or undervaluing a particular currency by market makers. Since market makers can move the market at will, if left ungoverned, they have the power to undervalue either currency of their choice. So as mentioned in part 1 of this course, market makers can move the market at will, and to govern that, the International Monetary Fund, alongside other external authorities, have put in place a policy whereby these market makers cannot move a currency pair by more than 220 pips per day. So this is probably for pound pairs, but it differs from pair to pair. Some are lower than others. For instance, the CAD JPY, CAD CHF, and so forth, they have lower daily ranges. Therefore, anything they push, these market makers, must always be terminated. So what we are saying is they are allowed, of course, to put in their funds, and this effects as impulsive rises, but they only need to push the market to a certain range per day on each particular pair, and then to terminate it, they'll either pull back or enter into consolidation to accumulate more contracts, and later get involved again, pull back, and so forth. So this is how these levels come into play on our charts. Then the psychological number. When creating levels, market makers moves in threes. Whenever they are going down or up in impulse, it is referred to as they are making level 1 or level 2. So in making the impulsive rise or drop, they usually issue them in threes, right? So before we talk on the guide on how to count levels, we need to know that smaller time frame levels are basically building blocks of higher time frame levels. So there are rules in levels counting. Unfortunately, we'll only review 1 out of 3 since the other 2 are in the paid masterclass. And for you to actually comprehend and understand the concept, you need to have the masterclass at hand. So smaller time frame levels are building blocks of higher time frame levels, as mentioned earlier. The level time frame theory, which is actually used in counting levels and seeing how the smaller time frames build up the higher time frames, states that every time frame level, meaning any time frame that you can open on your trading platform, consists of 3 levels of its standard preceding time frame. So what we are just meaning here is, if you open any time frame, its level on that particular time frame will consist of 3 levels of its standard preceding, meaning before the time frame it precedes, 3 levels of that particular time frame. So illustration of that concept is, let's say this is an H4 time frame. It is 1, 2, and 3. If we open the H4 time frame, the time frame it precedes, which is the H1 time frame, will consist of 3 levels on this one, 3 levels on this one, and 3 levels on this one. So as you can see, we have 3 sets of 3s. Therefore, we can say this is cycle 1, cycle 2, and cycle 3. And to interlink these cycles will require what we call reset points. Therefore, these are reset points, points where we are now restarting our cycles. So here are the rules of counting these levels, and the rule of counting states that for cycle 1, which is this one, the first one, for cycle 1, level 1 can be seen with a 1350 EMA crossover and a corresponding impulsive drop or rise. Level 2 can be seen with a 5200 EMA crossover with a corresponding impulsive rise or drop, and level 3 will actually initiate its price flow as a bounce on the 13 or 50 EMA. We need to see price bouncing on the 13 or 50 EMA, which are basically exponential moving averages applied to close. Then for cycle 2 and 3, unfortunately, you'll be required to refer to the paid masterclass to know how these it actually works in cycle 2 and cycle 3. So here's just an illustration of what we have been talking for cycle 1. Level 1, which was this impulsive rise from this point up to this point, we had a 1350 EMA crossover, and then level 2 from this point going to that point, we had a 200 EMA crossover. Then for third level, it was an initiation on the 50 EMA. So to fully understand, let's go over the charts to apply what we have learned. So this is Australian dollar against the US dollar, and we are going to apply the exact concept that we are talking on the slides. The first thing is to determine where is the highest point and where can we see and analyze to get to the point where there is current market movement. So in this case, we can see that the market is at this point and the highest point is there. From this highest point, there is a corresponding impulsive drop with its 1350 EMA crossover, a pullback, and then another drop, then with its corresponding 50-200 EMA crossover, and then a price bounce on the 50 to go down. So with this in place, we can safely say that there was a cycle completion in this particular drop. However, it's not necessary for us to see how these levels were actually performing, since we are not interested in any of this data. It's just to give us a point of view or clarity or a higher time frame picture of where the market is going. So we can mark the levels to see how they look like on this higher time frame. This is level 1, 1350, then level 2, 5200, and then level 3, price bounce on the 50 EMA, like this. So we can now say this was a peak, and as we have said, after 3 levels before the cycle is completed, we usually get what we call a reset point, which is basically a cycle restart. Therefore, we can see that we had 3 levels going down, and this is a point of restart, and our bias may be said to take us to go down. However, whenever you are analyzing the markets, you need to be flexible all the time. That is, you need to keep on checking how the market is reacting to particular things as we go. If we are to say and become rigid that the market is going to drop, we are saying at one point 1 Australian dollar is going to cost 42 cents. That is, it would have devalued the US dollar from 79 cents to this value. So we need to keep on checking how the market is moving so that we trade with the market makers, not against them. So if we go on the weekly time frame, this is what we see, which is literally the same as what we have seen on the monthly time frame. Therefore, to see what is happening and probably get an entry point, we need to see what's taking place at this point. So we will now go to a lower time frame, just what we did from monthly to the weekly. Now we are now going to the daily time frame. So on the daily time frame, this is what is happening. We can see that this is the highest point that we have referred to as the reset point. From this highest point, we had a 1350 EMA crossover here and a corresponding drop, a pullback, a 50-200 EMA crossover here and a corresponding drop, and price pulling back and retested the 13 to this point. Therefore, we can say that the cycle was completed on the daily time frame. And marking them, they will look like the first one, the second one, and then the last one. And as we have said, we need a reset point to continue with our flow if there is not yet a cycle completion. So in this case, we can say this is a reset point. So for us to get a point of entry, we now need to see what is taking place within this flow. So we now go to the smaller time frame which is the H4 time frame. And on this time frame, we can see that this is the highest point where we had a drop and a corresponding 1350 EMA crossover, then another drop and a corresponding 50-200 EMA crossover. So what are we now expecting? We expect to see price bounce on the 13 or 50 to see the last drop. So this is the first drop, then the second drop, and we are expecting to see the last drop to complete this cycle. So for us to get an exact point of entry, we keep on lowering our time frames. So if we are to look at this first H4 level that actually initiated at this point, we can see that there was a 1350 EMA crossover, 50-200 EMA crossover level 2, a price bounce on the 50 at level 3. Therefore, this was now a reset. So in this case, we are now saying we have 1, 2, and possibly 3, but we need a proper setup for us to deem this a peak. So we entered this trade in the VIP channel. It was a sell from this reset point, and now we are waiting to see reset number 2 to go down. So this is how you count these levels, and for you to get an entry point, you need to utilize the M15, which is the strike zone time frame. So on the strike zone time frame, that is where you'd find setups actually coming in place using the criteria of selection that we use in the masterclass. So with that, we come to the end of our video. Thank you for watching. Like and subscribe.